All right, so today we're going deep into intraday trading.
Oh, yeah.
And I have to say, I've been looking forward to this one for a while because the source material that you sent me, uh, it's amazing. Like it's got 50
50.
different intraday trading strategies.
Yeah, it's pretty comprehensive.
It is. I mean, that's
Oh,
that's a lot to digest. I mean, that's a lot of different ways to approach buying and selling, financial instruments, all within, the same trading day.
that's right. And it really highlights, when we talk about intraday trading, we're talking about focusing on these short-term price movements, right? And what these strategies show is that there's so many different ways you can approach it. It's not just simply, buy low, sell high.
Yeah, exactly. It's not just like gut feeling or kind of getting lucky.
It's
It's
not gambling.
it's not gambling at all. There's real methodology. There's rules and triggers and reasons behind these approaches.
Yeah.
So I really want to unpack some of these with you and kind of get a better understanding of these different approaches and kind
Yeah,
of
let's dive in.
yeah, let's dive in. So the first one, strategy number one, is scalping.
Okay.
Now, this one to me sounds like it's got to be, you got to have lightning fast reflexes.
Yeah, I mean, I think that's a fair assessment. When we're talking about scalping, we're talking about making a lot of trades.
Lots of trades.
Very frequent trades throughout the day and trying to capture very small profits on each trade. So you're in and out of positions extremely quickly, sometimes seconds, rarely more than a few minutes.
Oh, wow. Okay.
And I think a key element of scalping is tight stop loss orders.
Stop loss orders.
So if you're taking so many trades, you really need to manage your risk on each individual trade very carefully.
Oh, yeah.
And so you're looking for these small price discrepancies, you're looking for inefficiencies in the market and trying to profit from those very quickly and then moving on to the next trade.
So I guess for a certain personality type, that would be appealing, like if you to see that immediate feedback,
Right, exactly. I think there's definitely an element of that with scalping. You're getting that constant feedback.
but also the discipline required to like not let a small loss, turn into a bigger loss because you're doing so many trades.
Yeah, absolutely. I mean, I think discipline is key in all forms of trading, but especially in scalping where you're making so many decisions and you have to stick to your plan
Stick to the plan.
and not get emotional about any one particular trade.
Yeah. Okay. Interesting. All right. So let's move on to number two, momentum trading. This one to me sounds like, you're trying to catch a wave.
Yeah, you're trying to ride the momentum, catch the trend.
Yeah. So the strategy is buy stocks breaking out of resistance on high volume
Right.
and sell when momentum fades. Now, okay. So first of all, resistance, I know what resistance is, but for someone who maybe doesn't know what is resistance.
So resistance is essentially a price level where the stock has struggled to move higher in the past.
Okay.
So it's almost like an invisible ceiling.
I see.
And when a stock breaks through that resistance level, especially with strong volume, that's a sign of, strong buying interest and potential for the stock to continue to move higher.
Okay. So it's like it's been hitting its head against this ceiling and then all of a sudden it just
Breaks through.
yeah, and that breakout is often accompanied by a surge in volume. So a lot of shares are changing hands. So that's confirming the breakout is
Oh,
actually
exactly. Volume is like the fuel for the breakout.
I like that. So if you have a breakout with very low volume, it might not be as convincing.
Okay.
You really want to see that surge in volume to confirm that there's real buying interest behind the move.
Okay. I like that. And then the other key here is selling when momentum fades. Now, how do you figure out like when the momentum is fading, when it's time to get out?
Yeah, I mean, that's the art of momentum trading, right? Because you don't want to stay in the trade too long.
You don't want to miss that. You don't want to miss that peak. Exactly. You want to catch the wave, but you also want to get off the wave before it crashes. So some things to look for are diminishing volume as the stock continues to move higher. You might see the volume start to dry up.
Interesting. Okay.
And that could be a sign that the momentum is weakening. You might also see certain candlestick patterns emerge that suggest a potential reversal.
Okay.
You might also use technical indicators like the Relative Strength Index or RSI, which can help you identify overbought or oversold conditions.
Okay.
So there are a lot of tools that traders use to try to gauge when that momentum is starting to fade.
That's interesting because then the skill is being able to interpret all these different signals and kind of figure out when is the right time.
Right, and I think that's where experience comes in. A lot of these things you can learn from books and courses, but a lot of it comes down to just observing the market.
Getting a feel for it.
Yeah, getting a feel for how different stocks behave and how they react to different news events and different market conditions.
So you're developing almost like a sixth sense?
Yeah, I mean, you could say that it's like you're developing an intuition for the market.
That's fascinating. Okay, so the next one, strategy number 3, the breakout strategy.
Yeah.
This one seems very similar, but a little bit different. So The description is enter a trade when price breaks above resistance or below support with confirmation from volume.
Right.
So how is this one different than just chasing momentum?
I think the key difference with the breakout strategy is that you're really focused on that initial break.
Okay.
Right, so you're not necessarily waiting for the momentum to build up. You're trying to get in right at the moment that the price breaks through that key level.
So you're trying to catch it like right as it's
Yeah, you're trying to be the early
the
bird.
early bird.
Get the worm.
Get the word. I like that. Yeah, so you're not waiting for confirmation that it's really going to go. You're just like, I see the break I'm in.
Yeah, you're anticipating that the break is going to lead to a larger move.
Okay.
And that's why the confirmation from volume is so important.
Right.
Because if you have a break without volume, it might not be a real break.
It could be a false breakout,
Exactly.
which I guess would be a problem.
Right, and that's one of the risks with the breakout strategy is that you could get faked out.
So how do you like minimize the risk of getting faked out?
So there are a few things you can do. One is to look for the strength of the break.
Okay.
So if the price breaks through the level very decisively and quickly, that's generally a more reliable signal than a slow, hesitant break.
I see.
Another thing you can do is to wait for a pullback after the initial break.
Okay.
So the price might break through the level and then pull back slightly to retest that level. And if it holds that retest, that can be a good confirmation signal.
So you're waiting for it to kind of bounce off that level and be like, yeah,
Exactly. You're waiting for that second chance to end.
second chance. I like that. Yeah. All right. So that's breakout strategy. And then number 4, pullback strategy. This one says buy on a dip after a breakout when price retraces to a key level.
Right.
Like a moving average. So this seems like it's a little more patient. You're kind of waiting for things to settle down a little bit.
Yeah. I mean, I think the pullback strategy is a good example of a strategy that tries to take advantage of the fact that prices don't move in a straight line.
Right.
So even in a strong uptrend, you're going to have pullbacks along the way.
Okay.
And the pullback strategy is basically saying, okay, we had a breakout. We've identified this stock is strong, but let's wait for a dip.
Okay.
Let's wait for the price to come back down to a key level, like a moving average.
Right.
And then we'll buy it there because we're getting a better price.
Yeah, you get a bit of a discount.
Exactly. And we're also reducing our risk because we're not buying at the very top.
I see. So it's like you believe in the trend, you think it's going to continue, but you're just waiting for a little bit of a
A better entry point.
better entry point. I like it. Okay. So let's switch gears a little bit and talk about gaps. We've got 2 strategies here, 6 and 7 gap and gap fill.
Okay.
So what is a gap in trading?
So a gap is basically when a stock's opening price is significantly higher or lower than its previous day's closing price.
Okay.
So it's like there's a gap in the
A
chart.
literal gap.
A literal gap, yeah. And these gaps usually occur because of some kind of news or event that happened overnight.
Yeah.
So for example, if a company announces great earnings after the market closes,
Uh-huh.
the stock might gap up the next morning
Oh, I see.
because everyone's excited about the news.
Interesting.
And so the gap and go strategy is basically saying, okay, we see this gap, let's buy it.
Let's ride that gap.
Let's ride the momentum.
Okay.
We think the stock's going to continue to go up.
Okay. And then the gap fill strategy is kind of the opposite.
Yeah, the gap fill strategy is saying, okay, we see this gap, but we think it's going to close.
We think it's going to come back down.
Yeah, we think the price is going to revert back to where it was before the gap.
Okay, so how do you figure out like if a gap is more likely to go or to fill?
I mean, that's a tough question, and there's no easy answer.
Yeah.
But I think some things to look at are the strength of the news.
Okay.
So if it's really big news that's likely to have a long-term impact on the stock, then the gap is more likely to go.
Okay.
But if it's just kind of minor news or if the market is already kind of overbought, then the gap might be more likely to fill.
Okay.
You also want to look at the volume.
The volume again?
The volume is always important. So if you see a gap with very high volume, that's a sign that there's a lot of conviction behind the move.
Oh, interesting.
And that could make it more likely to go.
More likely to go. Okay, and then what about number 8? This one's called opening range breakout ORB.
Okay.
And this one's looking at what happens in like the first 15 to 30 minutes of trading.
Right.
So why is that initial period so important?
So the opening range is basically the high and low that a stock trades at during the first 15 to 30 minutes of the trading day.
Okay.
And a lot of traders believe that the opening range can set the tone for the rest of the day.
Interesting.
So if a stock breaks out above the high of the opening range, that's a bullish signal.
Okay.
And if it breaks down below the low of the opening range, that's a bearish signal.
Okay.
And so the ORB strategy is basically saying, okay, let's wait for the opening range to be established.
Okay.
And then we'll trade in the direction of the breakout.
So it's kind of like the market is telling you what it's going to do for the rest of the day.
Yeah, I mean, it's not a perfect
Of
predictor,
course, of course.
but it can be a helpful guide.
A helpful guide. Okay. All right. So let's move on to some strategies that use technical indicators. Number 11, moving average crossover.
Yeah.
This one seems like it's a little more systematic, less discretionary.
Yeah, I mean, moving average crossovers are a very popular technical indicator.
Okay.
And the basic idea is that you're looking for the point at which a shorter-term moving average crosses above or below a longer-term moving average.
Okay. So you've got like two lines on the chart.
Exactly.
And when they cross,
That's a signal.
that's a signal.
Okay, so for example, you might use a 9-day exponential moving average and a 50-day simple moving average.
Okay.
And when the 9-day crosses above the 50-day, that's a bullish signal.
Bullish.
And when the 9-day crosses below the 50-day, that's a bearish signal.
Okay. So it's like the short-term momentum is shifting relative to the long-term trend.
Exactly.
Okay. All right. What about number 12, Bollinger Band squeeze?
So Bollinger Bands are a measure of volatility,
Okay.
and they basically plot lines above and below a moving average.
Okay.
And the width of the bands is based on the standard deviation of the price.
All right.
So when the bands are narrow, that means volatility is low.
Low volatility.
And when the bands are wide, that means volatility is high.
Okay.
And so the Bollinger Band squeeze is basically saying, okay, we're looking for periods when the bands are really tight,
Okay.
because that often precedes a big move.
A big move.
Yeah, so it's like the market is coiling up
Boiling up.
like a spring,
Oh, I like that.
and then it's going to release all that energy in a big move.
So you're trying to anticipate that release.
Exactly.
Okay. I like that. All right. And then number 13, RSI, divergence.
So the RSI, or the Relative Strength Index, is a momentum oscillator,
Okay.
and it basically measures the strength of price movements.
Why?
And a divergence occurs when the price of a stock is making new highs or new lows, but the RSI is not confirming those highs or lows.
Interesting. So they're going in opposite directions.
Exactly. So, for example, you might see a stock making a new high, but the RSI is making a lower high,
Okay.
and that's a bearish divergence.
Bearish divergence.
Because it suggests that the momentum behind the rally is weakening.
Even though the price is still going up.
Exactly.
Interesting. Okay. So it's like a warning sign.
Yeah, it can be a sign that the trend is about to reverse.
Okay. All right. Let's switch gears again and talk about something a little bit different. Strategy 22, News Catalyst.
Okay.
This one seems like it can be really volatile.
Yeah, news catalysts can definitely create a lot of volatility in the market.
Okay.
Because when there's big news that comes out, it can cause a lot of traders to buy or sell a stock very quickly.
Right.
And so the news catalyst strategy is basically saying, okay, let's try to identify upcoming news events,
Okay.
like earnings announcements or FDA approvals,
Uh-huh.
and then let's trade the stock based on the news.
So you're trying to predict how the market is going to react to the news.
Exactly.
Oh, wow. That seems like it could be really tough.
Yeah, it can be very challenging.
And risky.
Yeah, definitely risky because the market can react in unexpected ways.
Yeah, you never know.
But it can also be very rewarding if you get it right.
If you get it right. Okay. All right. And then number 23, range trading. This one sounds a little more stable.
Yeah, range trading is a strategy that's best suited for markets that are not trending.
Okay, so they're kind of moving sideways.
Exactly. So the idea is to identify stocks that are trading within a well-defined range,
Okay.
and then to buy at the bottom of the range and sell at the top of the range.
Okay, so you're basically just playing the bounces.
Exactly.
All right, and then the last one that talked about is number 20, candlestick patterns.
Okay.
Now, I know these are visual representations of price movements,
Right.
but how do you actually use them in intraday trading strategies?
So candlestick patterns can be used to identify potential turning points in the market.
Okay.
So for example, you might see a candlestick pattern called a hammer,
A hammer.
which is a bullish reversal pattern.
Okay.
And so if you see a hammer forming at the bottom of a downtrend,
Uh-huh.
that could be a sign that the trend is about to reverse,
Okay.
and you might want to buy the stock.
Okay, so you're using it as like a confirmation signal.
Exactly.
Okay, and there's a lot of different patterns.
Yeah, there are hundreds of different candlestick patterns.
Oh, wow.
But some of the most common ones are the hammer, the doji, the engulfing pattern, the morning star, and the evening star.
Okay, so you're basically just looking for these patterns to emerge on the chart and then using that as information to make your trading decisions.
It's
Okay, wow. So we've covered a lot of ground here. We've talked about a lot of different intraday trading strategies. And I think it's really clear that there's a lot more to it than just, buying low and selling high.
Yeah, absolutely.
There's real methodology. There's real thought behind these approaches.
And a lot of skill involved, too.
A lot of skill. Yeah, For sure. So for our listeners out there, I think the key takeaway is that, success in trading is not just about knowing a particular strategy.
Right.
It's also about risk management. It's about understanding the market context, and it's about having the discipline to stick to your plan.
Yeah, I think that's a really important point.
And, we've only scratched the surface here. We've only talked about 15 of the 50 strategies.
There's a lot more to
There's a
explore.
lot more to explore. And so I guess the final thought I would leave our listeners with is, this is just a small glimpse into the world of intraday trading.
Yeah.
And it really shows you how complex and sophisticated the financial markets are
And how much opportunity there is.
and how much opportunity there is. So, if any of these strategies have piqued your interest, definitely go out and do some more research.
Yeah, there's a lot of great resources available online.
And, see if it's something that you might want to explore further.
Yeah, I think it's a fascinating field.
It is. It is. And it's a lot of fun, too. All right. Thanks for taking this deep dive with us.
My pleasure.
We'll see you next time.
See you later.
Bye.